Gentlemen, good to see you all again. I think I say this every time, but I feel like it's been a long time since we've done one of these. But how's everybody doing?
Awesome, thanks. Yourself?
Great. Yeah, been relatively quiet lately, and I really like it. We're focusing on writing mostly and trying to get a book at least to a draft that I can start, looking at a finish line, getting closer to the finish line. So that's been very rewarding, but also very challenging. So but I'm enjoying the solitude. It's nice to tune everything out and focus on one particular thing. What about you guys?
Not
Well,
much,
it's
man.
Foss here.
Good,
Oh, sorry,
good, Greg.
go.
Good, Greg.
Hey, boys, I'm just on a train riding into Toronto. So after this, I'm gonna go on dark screen. But you can't miss a JV with Jeff Booth and Preston Fish podcast, even though I double booked myself somehow in this foolish world of mine. But I'm gonna go on screen off or video off, and I just want to say it's always a pleasure to be on with you. Three gentlemen. It's been a great journey since we first met back in Bitcoin Miami. So can't miss it, boys. Thank you.
Awesome. Preston, what's new in your
Likewise
world?
to Greg, yes. Yeah, not too much, man. Just the usual, just kind of watching this price action, looking at the markets, seeing the yield curve kind of uninvert itself, which is usually a signal for interesting things to come in markets as far as like unemployment and whatnot. So and Nouriel Rubini just launched his own token that is AI, ML, climate technology, and blockchain all wrapped into one. I mean, how much more exciting can things get?
Isn't it nuts?
It's outrageous.
I thought it was a joke. I thought somebody was just clowning around, but it's a true clown token. I mean, this thing is like as clown as you can get.
Put all the buzzwords together.
Yeah,
Stamp
from
Nobel
the
laureate
guy.
economist that's been the biggest hater on Bitcoin ever onto it, and there you go. That's what you have. That's the Frankenstein child of all those things together. Be interesting to see when he actually comes out and has to say
Greg's
something
back.
about it. Well, speaking of which, Preston, I mean, and we say this too every time we get together, but there's a lot going on in macro world, and I mean, things seem to be coming to a bit of a head, at least for this recession that we've been talking about probably for the last year. And as you say, the traditional indicators are starting to point to that, and that may facilitate or lead into rate pauses / cuts, and that is often the arbiter of the big event that characterizes any particular downturn. So why don't you give me your 10,000 foot view on what's going on right now?
Yeah, so I would just I'll tell you what, let me build a chart while we're talking, and then I'll come back and kind of show you kind of graphically when a lot of these so like we went through this period where like long duration bonds were providing lower yields than the shorter duration stuff. And when you kind of mix those spreads between long duration and short duration, and you kind of show it graphically, you can see in past recessions how once that started to uninvert itself, it was a precursor in the timeline of like what was coming next, which was a lot of unemployment. So we're starting to see that uninvert itself. So I'll build kind of a chart here while we're talking and kind of graphically show you kind of where we're at in that timeline and like what it meant for unemployment going forward. But just give me a couple seconds and I'll kind of show you where you're at. So Jeff, I don't know if you want to kind of talk to that or maybe something different.
I'll talk to something at a higher level, because I think what's happening here is so. I think most people are so confused by economics because it's meant to be confusing that they miss the simplest thing on the planet, the absolutely simplest thing, that in a free market, deflation is the norm. Every year, prices fall and you get richer as productivity flows to society through the form of lower prices. That's economics. Everything we live in is a structure to try to accrete power through a structure that stops that. And that structure has to constantly lie and manipulate and make up new rules and have people like Rubini tell you why you don't know what you're doing. And all of the things we're talking about in macro are inside that other structure, waiting for something to break, right? Everything, every single action. And you just imagine the cost to society of all of that just bullshit. It's just complete bullshit. And what Bitcoin's doing is repricing the whole thing over a long time horizon, and it doesn't care. It doesn't care about what people are saying over here. It's just complete nuts, and you can see it, right? I use my house example. My lake house cost $1.4 million in the fiat world 3.5 years ago. Today it's $2.1 million. In Bitcoin, my lake house cost $300 or 300 Bitcoin in the Bitcoin world 3.5 years ago, and today it costs 40 Bitcoin. And so in a system that can't be manipulated, all prices are falling in accordance to the free market. And there's nothing that anyone can do about that as long as Bitcoin stays decentralized and secure. It will reprice everything else. And so at that level, I'm fascinated in all the intricacies of how things move, when they move, what that looks like. But at that level, the macro, that's what's happening globally. And it's not negotiating with anything.
I totally agree. Just 1 second, Jeff. Preston, how do I do that? How do I give you the control to?
I think you, Jeff, I don't know if you know how to.
Yeah, share screen.
Do I make you a host?
I clicked on that, but he has to give me the.
Yeah, it has to be
Greg,
John.
I think you need to go on mute there.
I'll make you a host, Preston. Let's try that.
Yeah, that should do it. And I'm muting Greg there. Okay. All right. I think I can. Okay, perfect. I can do it.
Like you've done this before.
All right. So here's the graphic. So just to kind of orient people to what this is, because this looks like a bunch of squiggly lines. You got a very long timeline here that we're looking at. This goes back to 1993. And on the top is various credit spreads. So like the orange one here is the 30-year minus the 3-month. So if we had, let's say the 30-year was yielding 5% and the 3-month note was yielding 2%, you would have a positive 3% number right here, which is kind of what people should expect. Like if I'm going to lend out money, I expect to receive a pretty large return versus lending money out for 3 months. Like it's just natural that you should expect a higher yield. But when you get in these really weird credit events where you're having liquidity issues, what happens is the long duration stuff actually isn't as in demand as the short duration stuff. And so you get in these odd scenarios where like short duration money, 3-month money is yielding actually higher than the long duration money. So when you're looking at this chart, and we're just talking about the 30 minus the 3-month, you can see here in January of 2007 that was at its peak negative inverted where short duration money was yielding actually higher than long duration money to the tune of negative 36 bips. Okay. And when down here on the bottom, we have the S&P 500. So look at where the S&P 500's performance was at during that, unique point in time where short duration money was yielding higher than long duration money. You can see it right there. Then you could go back to the 2000 period of time and you can see it went negative. This is 0, by the way, right here where I have the line, and anything underneath of that is a negative inverted yield curve. Okay. And so look at where the equity market, the S&P 500 was at back in the 2000 timeframe. Okay. So here's where we're at right now in today, where this thing has been negative for a very long period of time. I would argue most of all the spreads went negative back here in what was this time frame back in late 2022, and then I would say we hit the peak of that 371 days later, a year later. And I would say that we hit this, what's the date here? Around June. It was this past summer that you reached the peak of this negative. I think it's uninverting itself right now, which means there's pain on the horizon. So when we just take a quick measurement from the bottom of these negative spreads, and you look at the depth of the 2008 crisis, you were in the summer of 2009, maybe the beginning of 2009, about here, that manifested itself 766 days after you were at the peak inversion of your credit spreads, which would imply that if that happened this summer, like, you're not going to get to the depths of like what's brewing for probably another year to another year and a half, 2 years from the summer of 23, just to kind of give people an idea of like where we're at in the timeline of some of this stuff. Now I'm going to stop sharing the screen. You good on the screen, John? Did I kind of explain it, or did you have any questions on the graphic?
Well, I understand it. A couple of questions on it. One, just in general, I think it would be helpful to explain why the market would value a higher yield on a short-term basis. You know, like what's happening in the market? Is it you know, the risk, the longer term risk involved, or is it the necessity for cash because of the level of debt and the interest rates?
That's it. So like, you have to come up with cash. You have to come up with liquidity to service your impairment that you're dealing with. And so to do that, you have to sell that. The other thing that I think is important when you think about like just the sheer loss that has occurred on long duration instruments, the banks were able to put them on deposit at the backstop facility, which had a huge impact as to like not having to deal with economic reality. Like, I don't have to deal with that pain. I can just put it on deposit at the backstop facility, collect the par value, pay a small nominal interest rate for exercising that facility, and then I don't have to sell it. And then I'm just going to wait for the next crash, and hopefully rates are going to come back down, and then I'll put it back on my balance sheet and get rid of that thing. Is kind of the mindset.
Preston, can I just jump into that, because I think that's really, really important at a way higher level. The entire global system is not marked to market. It's not just right.
Say it louder. Say it louder.
It's just not. It's not just banks, but it's every. So there's hedge funds right now. There's private equity funds. There's venture funds that are closing the doors on selling, and so people think they have that money, but if the selling was allowed to happen, the money wouldn't be there because it would fall to almost nothing. The liquidation of that event. So globally, what's happening is we're pretending not to mark to market, waiting for a massive infusion of liquidity so that these things aren't impaired. And if they are impaired, everything fails. So you know this liquidity is coming at some point, but how bad this is going to get on the back of this, because we're living in make-believe land, right? Nothing's mark to market, the globe.
So like all of this would have started to unravel itself, and you would have had this try to reverse itself back during the Silicon Valley Bank if they would have let it fail, and they would have.
It would have happened in 2008, actually.
Yeah.
2008 is when it would have happened. And then what you did is by extending and pretending, you sent a note to capitalism that said, we're for sale. Right. And what happened is everybody that if you get too big to fail, the government has to drive in and save you at the taxpayer's expense. So it created crony capitalism, and you're living on a way bigger bubble than 2008, exponentially larger, out of the same thing.
Before we move on from that graph, Preston, two questions. One, so short-term rates go up because people need short-term cash to service debt, basically. Should that then be understood that the un-inversion, that dynamic is changing? I mean, presumably with rates still very high, people still need cash. Why is the curve un-inverting now?
That's a good question. I think Greg would have to. I don't know if Greg's listening.
Yeah,
he might do a better job of explaining that than I can.
The long duration bonds will anticipate Fed movements much less so than the 2-year. And that's reflected in the 3-month as well. Right, Preston? So what we have is a market that is wrestling with a recession outcome. And then, in my opinion, the Stanley Druckenmillers of the world that are levering up the 2-year position as a long, anticipating Fed rate cuts. So it's a twisting bull market steepeners, bear market steepeners, different words for them.
That's actually really well said. It's really well said. Essentially, the market is betting on the Fed when the Fed is going to have to cut and stimulate.
Right. And then the second question from that graph, Preston, is obviously it seems like the current inversion, as long as it's been, let's say from summer last year or whatever, has been far steeper and far deeper than at least the other two that were represented on that chart. And you could see it, the increase in the S&P was also much steeper leading up to it. And of course, this implies that the decline in the S&P is going to be probably sharper and deeper than those times as well. Correct?
Well, so this is where this gets really difficult to forecast, because if we were prior to like the environment that we're in right now, which is turning into absolute manipulation, where before I would say it was much less so in these previous cycles over the last 40 years. When you get to this point, what everybody is starting to do is the math that James Lavish and many others keep talking about is this debt spiral. So they're looking at it and they're saying, holy hell, like they're not just going to print and manipulate this a little bit. Like, it's going to be absurd, the amount of debasement that comes into this. So what hard assets that can't be debased through the fiat experiment should I own? Historically, it was like everybody would run to bonds because that was their protection, and they knew that they could keep adjusting that and manipulating that so that it got more and more valuable. But now I think everybody has the exact opposite opinion, that after they intervene this next time and add all this liquidity into the system, who in the world wants to own a bond when they know that the value has to basically go up in smoke?
Preston.
Be a half.
Exactly. The credit concerns, whether it's debasement, credit concerns reflected in debasement, or outright credit concerns, the interest expense, the debt spiral, as James Lavish always says.
So the question then becomes, so equity, quality equity that actually generates free cash flows will be desirable to store your economic energy in. Okay. So when we look at the performance of equities in the past, they got crushed through this re-steepening or un-inversion of credit. But on this next cycle, I don't necessarily know. I don't know, but it wouldn't surprise me in the least bit if high quality equity bid and did actually really well through this event, because people have to store their buying power somewhere, because they're pulling it out of these things that are dying, like just soul suckers, like sucking the monetary energy out of hundreds of trillions in credit. Where does it go? Where does that, where do those units go?
Can I jump into that? And I think that's what Preston just said is true. That's what's going to happen. But it's actually, those people are going to also lose money. They're just not going to lose money as fast. That's what
in Bitcoin terms, relative to Bitcoin,
because the revenue they're making in dollars that are being inflated away is essentially Bitcoin sucking into that. Give you a different take on this. What would so you guys know my thesis and why I use that exponential example, the paper folding example. is because if you were looking at the rate of growth of an AI over 70 years logarithmically and projecting that forward, you would know exactly where we were today. And that's what I was referencing in my book. The mirror image of that, you would know exactly what would happen to the debt stack, and then the amount of easing that would come in, because it has to steal that productivity. It has to make prices go up in something that should drive prices down. And from there, you could say, who would win the most? So we know it's theft. Inflation is theft of that, right? And then who would win the most? The people that would win the most would be in charge of the AI companies and the biggest AI companies. So when you look at the Magnificent Seven, essentially, they're stealing that productivity the fastest, right? Because they're able to remove labor and leverage all of this at a scale that other people can't. And we use those tools because it gives us so much value. And that's where people are storing their wealth into those companies. So no wonder there is no S&P growth without those companies. And so the bigger you are, the more that this is like, it literally is just taking the productivity that should be flowing to society in the form of lower prices and inverting it and putting it in the largest companies. Why do you think those largest companies are are driving to regulate AI? It's not because of fear. It's because there's no moat on AI. If prices fall to the marginal cost of production, period. The marginal cost of production of a line of code creating other lines of code is zero. So there is no moat. The only moat is if there's so much fear and they have so much power that they convince people to regulate it to give them a moat. So we transfer more wealth to those companies. So like that's the piece. All of this is connected and it's getting worse and worse. And all of the people inside this connection are trying to store their money in the things that's making it worse. Does that make sense?
That makes perfect sense.
Right. It's similar to why we would buy more houses, right? Because for a long time, our money didn't lose money as fast if we bought a house. Right. Similar reasons. So you have this perverse incentive that all of the money is trying to just not lose their money, making the thing that's happening to the world worse and worse. And Bitcoin is the only escape from that, because it's a different system without counterparty risk to that system. It's repricing everything. It's the only possible escape. Now, will most people see it? No, most people will do exactly what Preston said and think they're winning, picking up pennies in front of a steamroller inside that system while it gets worse.
Very well said. And of course, I totally agree. And Preston, can you change the speaker view? You're the boss here, so it's in gallery view right now.
I don't know how to do this.
If you're done graph sharing, you can make me the host again, and I'll do it
like that. Oh, okay.
I'm not sure. I'm on speaker view anyways. I'm looking at the Twitter video.
Hey fellas, that's a fantastic. As always, learning stuff with Jeff Booth and Preston. Guys, I'm gonna jump. I'm not sure if I added any value except to say this. I love you guys. I love the true thinkers in the Bitcoin community. And it's times like this where you realize that's why Bitcoin will win, is because of guys like you.
And
okay,
you.
So, well,
right,
I love you guys. Buddy. Okay, I love you guys and look forward to watching the full show. I really hope that that everybody takes to heart how true the message coming out of the Bitcoin community is. Okay, so thanks, love from Canada.
Love you too, Foss. Thanks for joining.
See you, bro. See you guys.
See you, Greg.
Bye, guys.
Preston, make me the host again, and I'll
okay. Yeah, gotcha here. Oh, geez.
Preston, aren't you a podcaster? Can't you figure?
Oh, what a disaster.
But you know,
true
so
technical competence is coming out on full display.
we keep we're speaking in two different levels of what's going on. Obviously, Jeff is speaking from a more broad view of things, which I know we all agree with, and then Preston, you're kind of dialing into how is the dumpster fire of fiat going to perhaps unfold in the next whatever period. And one of the things I was thinking, this is kind of tangential, but as you're saying, that the monetization basically of stocks, right? Because people are going to lose a safe haven. And so even though historically stocks would have sold off big based on these charts, and they still may do so, you're not saying it's a certainty that things are going to materially change in terms of how people are going to react to this stuff. But it may be the case that because the bond option is not there, that the equity option ascends, and people choose that. And the Magnificent Seven, as you say, have been sucking in all the capital, basically. But you did say that, one of the other things that people may choose, whether it's, in public equities or perhaps elsewhere, is basically cash flow, a healthy business. And I couldn't help but think of MicroStrategy, right? Because you have a healthy, cash flow positive, profitable business who is also leveraging their balance sheet with Bitcoin to rectify some of those issues that we've addressed. And as a result, put themselves in a better position, both to execute on their business and, grow it, being infused in various ways with Bitcoin. And what do you know? That stock has outperformed, correct me if I'm wrong, Preston, you're probably closer to this, but maybe with the exception of maybe NVIDIA, I haven't been watching it that closely, but it's over since that strategy has been adopted, in the fall of 2020, it seems to have worked out exceptionally well. And so does this bode well for the future of MicroStrategy, do you think, or this brewing scenario in the short to medium term?
I think that one of the most exciting things for me when it comes to MicroStrategy is that Michael didn't do this with 5% of his marketable securities or his treasury. He did it with his entire liquid, what would normally be a marketable security portion of your balance sheet. Because he did that, and because it is just so in your face from a corporate standpoint, I think he's going to greatly accelerate the pace of other businesses following suit in some capacity. I don't think other companies are going to do it with the magnitude that he went into it. But I do think that them starting to allocate a 5% or 10% of their marketable securities in their balance sheet towards Bitcoin is going to be way more to the left in the timeline than what would have happened if Michael Saylor didn't put this on in full display for everybody to see.
Sure.
And I think that in the coming cycle, you're going to see a lot of companies start to allocate into this in a way that would be unimaginable to people, call it 4 years ago.
Totally agree. I see a bunch of private companies that have already done that as well.
Yeah.
Well,
Yeah,
it's
on the
hard not
private
to
side,
when
for
you
sure.
see Saylor on, whatever financial news show, and he's just sat back, relaxed, smile on his face, moisturized, and the people are asking him about the stellar performance of MicroStrategy, and are you still a Bitcoin bull, and what about all this Bitcoin buying? And he just very matter-of-factly tells him, the thinking behind the strategy, and then the results speak for themselves. And you got to imagine there's people that need solutions to these problems that everyone is facing right now, looking at that guy in that interview and be like, I wonder if we could do something like that. I wonder if we would have results like that if we followed a similar strategy. And I'm almost surprised that not as many have done it up to this point. But if what we're saying about this brewing scenario is correct, that there's going to be an imperative for a lot more people to find a solution. And there's so many closed doors, there's not very many viable solutions out there, as we've been saying, with regard to, bonds and inflation and other options. So, I tend to agree that others are going to be looking at doing the same thing.
So one thing just kind of from psychology that drives markets and what this, when you're stuck in a company, you typically don't have the mental capacity to be able to think totally different and drive something totally different. So you see companies do the same thing over and over and over again instead of change the company radically. It is a rare thing what Michael Saylor did. But Michael Saylor is a rare person in his thinking at the first principles. And so he went down to the sand on this, understands the same thing you do, understands the same thing I do, Preston. That he went down the sand on this and said, wait, everything else is a risk. This is not a risk. The market believes it's a risk, right? But it's actually the least risk thing that I could do to be able to change my entire company. Very few people both have the CEOs don't have the magnitude, the ownership of a public company to do that like he did. Number one, so they are going to their boards, and all their boards see it as risk. And worse is it, like when you're pushing against something, you could try to keep on pushing. Like very few can rise up to say, wait, I could look at this totally different and take advantage of this by looking at first principles. So, well, I do think a lot of people will start to see this. Some of the companies just won't be able to because they don't have the free cash flow. They don't have. They're already non-performing.
Half of them, at least.
Half of the companies are non-performing, and the new interest rate structure and everything else, like they're already zombies.
Yeah. John, I wanted to bring up one more chart to kind of demo what we're talking about right now, which is the performance of MicroStrategy.
I made you host again. Go for it.
Okay. So let's see here. Here's the chart. And as you guys are looking at this chart that I have pulled up, there's 3 lines here. The orange one is MicroStrategy, since Michael basically turning his treasury into a Bitcoin treasury on any type of retained earnings that the company makes. And you can see his performance since implementing this, just from a stock standpoint, is he's up 276%. And I'm using kind of a ballpark of what do we got here? August of 2020. I think he maybe implemented it a little bit before that. But so that's his performance. Then when you look at the orange color, that is the top 7 companies in the US, which is Apple, Microsoft, Amazon, Meta, Tesla.
NVIDIA,
okay.
Yeah.
And then you have the S&P 500 in blue, and you can just kind of see that performance. But I'm going to take MicroStrategy off here. And the reason I wanted to show this is because Jeff was talking about like a lot of the buying power kind of nesting itself into these top mega companies, these tech companies. And you can see, I mean, you haven't made a new all-time high yet, but it's in contention, right? Where we're at right now. So in whatever materializes out of this cascading liquidity event that's on the horizon, that is going to be a Silicon Valley Bank like thing that occurs. And I think it's going to occur in the next 12 months, most likely around whenever the reverse repo, gets to 0, which, many
it's
are
likely.
saying
Yeah, I'm thinking more like 6 months, right? I'd take under on that. Yeah.
Yeah. So a lot of people are thinking that happens by January, that the reverse repo is completely, sucked out and it's down to 0. And then things are going to get really interesting. You might have some type of cascading liquidity type event that lasts for, I don't know how many days or months, but the amount of liquidity that's then going to be shoved back into the system, I think, is going to cause these top 7 companies to bid like crazy. The companies that Jeff's talking about that aren't making free cash flows, they're going to get crushed. That equity chart would look disastrous. And I think that's where there's going to be a lot of dislocation from like previous market cycles, that people think they can fully understand what's going to happen because it's just going to look like this last market cycle. I don't think it's going to be that.
Sorry, you keep going, then I want to jump in.
No, and I think in particular where it's not going to be the same is in fixed income. So like fixed income would get bid, it would get aggressively bid. You would make a ton of money in fixed income through those types of events because it was the flight to safety. And I think you might see that for a very short period of time, just as a what's the word I'm looking for, Jeff? Almost like a creature of habit, or like that's how it's always worked. So that trade gets put on, and it's definitely a trade. It is not an investment. There's Wall Street that's just playing the momentum. And then I think it's going to swing back, and the sell-off is going to be unimaginable. And I think the government is already fully expecting that, and they're going to be ready with yield curve control to peg those yields across the duration, because they cannot allow it to happen. They cannot allow that to manifest itself in a free and open market kind of way. They just cannot.
And so just playing on that, when you get to these points in a cycle that is just literally all manipulation and things have to change, right? And you have to lock people in. Just keep in mind, for a lot of different things that you've never expected in your past could happen instantly. Like banks could close for 4 or 5 days, right? Well, something like this is worked out to be able to take this. And you can see banks right now stopping allowing you from taking out larger amounts of money, essentially locking the doors, getting ready to, because if there's a run on the banking and a liquidity squeeze, this thing starts to unravel really fast. So you have to, and prior cycles didn't have Bitcoin, right? Prior cycles weren't moving this fast. So you could prior cycles, in the 40s, when US had to do financial repression, there wasn't another country that was vying for economic control. So it looked very different, and people just had to put up, and the market wasn't moving as fast, information wasn't moving as fast. And so you could run financial repression on a population for a long time and get back into a debt service that was this is so different, because you have a counterpart, you have something that's outside of the system that people can just walk across and measure a new system, and it's getting stronger and stronger as this one gets weaker. So you could expect from these actions all sorts of things to try to stop the new system from growing, to try to stop people, to keep them locked in. So when governments are saying these things, and when Liz Warren writes the letter and everything else, these are coordinated responses to try to get people fearful, to keep them locked into the burning building.
Yes.
And because there's just no other way. Mathematically, it is impossible for this system to survive against the forces of technology moving the other way at an exponential rate. And so the only thing that can rebuild it is a new system that doesn't have counterparty to that. But most people will stay in the existing system with all the risk.
And ask for more of that intervention, because they'll think that's the solution, right?
So this is one of the things that George Gammon, from life, I like him and everything else, but this isn't what he misses what comes first, right? He misses the correlation, not causation. He misses the cause. So when he looks back at his charts and he sees, look in these past cycles, government spending went up. He misses because government spending goes up because people demand it to go up, because they can't feed their families. They can't. So all of the government spending explodes to be able to fill the gap that the private market can't, and people vote for it. So in this case too, people will just ask everybody who owns houses right now, if those houses were marked to market on a credit event, and those houses fell by like 90%, would they be voting for more manipulation of money? Of course they would. Right? Mm-hmm. The entire thing would. So it's not governments, it's us empowering them by the system that we live in. Same thing that's driving the big tech companies. And the same reason the big tech companies are probably not driving to Bitcoin as fast, because they benefit from a theft of productivity, and they benefit. The higher you are in that system, the more you benefit from that theft from the rest of the population.
Right.
And so this is all just totally natural. And as we get locked into that system, we become more fearful, and we give it more power.
Which, John, if we're going to put labels on things, I mean, I believe that is the definition of fascism, right? The collusion of state and corporate power, right? And people think it's done in one fell swoop or a declaration of a new government, but it's not. It's done in this creepy, surreptitious way where you don't notice it, where you're just giving more and more power to those who you presume to be acting on your behalf, and that's being funneled to and enabled by those corporate powers, and those two interests keep getting closer and closer and closer together until effectively, though not superficially, but effectively or fundamentally, they are the same entity. Their interests are so aligned that they act in the same way.
Patriot Act leads to less and less to be able to surveil, maybe leads to the next thing, leads to all from fear caused by weapons of mass destruction in Iraq that were never actually found, right? That caused by a whole bunch of things that create a fear event to be able to remove individual rights and freedom slowly, because people will vote for it. And so all of these things from the existing system are totally natural, and you could expect more and more and more from them. I try not to give them much, even though I know all of this happens. If you understand the structure of what's happening, okay, if that's going to happen, I'm not. I'm going to build the new system as fast as possible with the people that are building the new system, and it's actually why we're all so close friends and stuff, because the people that are building that new system, you see hope, you see truth, you see abundance, and you see a totally different world emerging than the world that we're living in today.
Jeff, I'd like to ask you something about that, but Preston, did you have something you want to jump in with first?
Oh, I was just going to say and this is much more granular than the conversation you guys were having. I made the comment that on this next go around, like when they do get some type of cascading impairment that hits the market, that they're going to allow it to occur. You might see a bid in fixed income for a short period of time, and then they're going to try to lock in yield curve control at that point. The reason why I'm so confident and like why I think that is just a matter of fact kind of statement is because I don't think real estate, and I don't think the cap rates on everything that's been capitalized, the multiples on earnings, and in particular real estate, can handle interest rates at these levels or higher.
Yeah.
I think we're seeing right now, I mean, some of these buildings that you're seeing, the prices on some of this commercial real estate is so insane. The reduction compared to where they were priced when interest rates were nothing.
You see the one in St. Louis, the $4 million
one in St. Louis. Like I think what did it go for? It went for over 100 million, and now it's at like 1.5 or 2 million or something like that. So like there's a reduction of like 98, 99% in the value of like prime time downtown real estate, commercial real estate. And
by the way, the banks own these, right? So where is the money when they go broke?
Yeah.
Right.
And so I had a post on Twitter yesterday, just complete parody, but maybe not. I don't know. But it was meant as a joke of like, when are we going to stand up the next backstop facility where the banks can basically put their deeds for all this commercial real estate on deposit at the Fed and basically get the par value or the last paid price for the commercial real estate to make sure that those 90% losses on commercial real estate don't manifest themselves onto their balance sheet. Because like that's, I guess, next. I don't know. It sounds so ludicrous that like it's laughable, but maybe it's not. I don't know. Like we're in such clown world at this point that it wouldn't surprise me if something as insane as that happened.
The same thing is happening. By the way, the same thing's happening in China, maybe even on a greater scale. The same thing, cascading all around the world on a staggering scale. So this, and that's why I said that we're living in a belief structure system that nothing's mark to market. There is no market. There's no real market.
Two things to kind of zoom out to talk to the points that you guys were making. The first one is just when you're looking at like what drives this, like what has resulted in us getting here. It's really simple. It's first principles. It's when you overconsume and you pull your future into today, and you do that relentlessly over and over and over again, and then the bill comes to be paid, and you're not making enough to service that debt. That's what causes this. The second point that I would make is once we went to a truly fiat system on a global scale, you entered into this really strange dynamic of a tragedy of the commons to debase your currency. and to like, if let's just say Americans, we were actually playing by the rules, which we weren't. And we were like, we are going to have sound money, or we're going to have a sound ledger, even though it's not backed by anything. If we put an extra unit in, we are going to take that unit back out of the system, and we're not going to allow it to expand. Okay. If you do that, and everybody else on the planet is also on their own ledger system that's not backed by gold or backed by anything, you are incentivizing cheating in this system, which is a tragedy of the commons for fiat currency. Because if, let's say, Britain doesn't want to play by the rules, or whoever else, if they debase their currency, their goods and services become cheaper, and they attract all this other currency from around the world into their domain, and they benefit from that. Okay. So there was this really strange dynamic where everybody was incentivized through tragedy of the commons amongst fiat currencies to take the bait of not having an honest ledger. And so that's how we got over decades. That's how we got here.
Can I give you a very real example of what he's talking about? Right? Very real example. So that yin and yang, the trade balance of the world has to equal zero, right? There has to be sellers, there has to be buyers. And so for a long time, we looked at China, and China looked at it as, okay, here's going to be the sellers to the world. And then, and instead of revaluing their dollar up, they kept it pegged against the US. And so the US had to be the buyers of the world, and the China had to be the sellers. And because China was growing so fast because of that export market, it had massive investment into it. And then in 2014, the US knows this too from a geopolitical thing, because that Triffin dilemma creates essentially for the industrial base of the US, you could never onshore your industrial base if your labor costs way more than somebody else's. And so what China did in 2014 is stopped buying US treasuries and started using essentially the American taxpayer to build Belt and Road, by still keeping that peg and driving it into investing and being a geopolitical adversary with that peg to the dollar. So what Preston is saying is, you can see this playing out now that China is kind of another superpower. Now this tragedy of the commons, everybody pegging to try to the US's dollar strength becomes its weakness, because the jobs can't come to the US. The manufacturing base doesn't come to the US. It goes to the cheapest domain, and other countries are racing to be the cheapest domain. Now, in one sense, that allows the US relative strength to keep this system going for longer, because what it means is all of the other places in the world, like our EVs wouldn't work unless you were digging a cobalt out of the ground in Ghana for $2 a day, right? And so that massive inflation rate, that stealing of productivity from those people, actually favors the US in that way, because it keeps a lid on inflation, and the US is exporting inflation to these other countries. But that's now we have a new honest ledger, a new global honest ledger that doesn't care about all these games, right? It's a neutral money that you can't. It's actually out of World War II and Bretton Woods. The whole idea was to be able to create a neutral money, but the U.S. was the superpower at the time, and it had it gold pegged to the U.S. dollar, and was able to, and we're back where we started.
I'll preface this comment by saying, do you guys are asking, I mean, it may be a silly question, but there seems to be so much going on in the world, basically since COVID. It seems like we're really in a historical moment now versus just kind of, not being in such a discernible historical moment for the previous, 20, 30 or whatever it was years. And, so I don't know if you guys agree with that, but you can tack on your answer to the answer to this question, which is, so let's say there's a credit event in the next 6 to 12 months. And let's say the bottom of that in terms of markets is 6 to 12 months after that, something like we were discussing before, Preston. and there has to be intervention, right? There's money printing, there's QE, there's yield curve control. Presumably that the inflation genie comes right back out of the box and we have those problems again. Now you guys can comment on that, but to go to your point about when things destabilize, and this has been the case in the past, you know, again, World War II, and I think it was Dylan who shared maybe it was an IMF or BIS paper like, you know, 3 or 4 months ago, which was making, you know, a academic case for financial repression as a resolution to, you know, overbearing debt burdens, let's say, you know, situations you can't get out of. How do you rectify that as a monetary authority or as a government? And financial repression was one of the ways to do it. And as Jeff was saying, you know, now there's a trap door. Prior to Bitcoin, there wasn't. You just had to deal with the repression. You had to deal with the theft of your purchasing power. You had to deal with not getting access to your money. You had to deal with controls of various kinds, how you spend, how you send, all that kind of stuff. Now that is gone. And so we're seeing the recognition of that and all these Elizabeth Warren types and the various things that are coming down the pike to try to account for that, to try to say, okay, we know we're going to need financial repression. We know that this trapdoor exists. How do we put a gate, a lock, you know, a trapdoor on the trapdoor, whatever it may be, to make it so that that doesn't screw with our plans? Now, you know, the hardcore Bitcoiners among us may say, well, have fun trying, you know?
Exactly.
Yeah, absolutely. But not without, you know, effort by each individual Bitcoiner, because there will be many means by which they can make your life more difficult. They can invade your privacy. They can do all these things. So it's going to be a bit of a game of cat and mouse, in my opinion. You're going to have to be sensible and conscious and educated by how you access that trap door. It's not going to be just as easy as, you know, grabbing the handle and stepping through it as it might have been before. But let's say, you know, that continues to happen. Then we get, Jeff, you invoked the example of the Patriot Act before, which I totally agree with. And here we are again in a time, whatever your current feelings are about the wars happening in the world, Russia, Ukraine, Israel, and Gaza, they are used as, you know,
they consolidate more power.
Exactly.
Like you couldn't get away with the system unless you did that.
Right. So to restrict more speech, to, you know, make enemies out of normal people more, to take away rights, as you were saying. And so my question, long-winded way of coming around to it, is, are we at a point, both from a perspective of the debt burdens of various countries, including the US, the potential for inflation when all these measures are, you know, kicked back into gear, the existence of such a threatening alternative in Bitcoin, and to your kind of thesis, Jeff, I think AI, you know, had its moment last November, right? It really came on the scene with ChatGPT, and people, it's in the consciousness, you know, significantly now. And people realize, you know, you might not have gotten the exponential growth thesis before, you know, leading up to that. Yes, you know, Facebook and YouTube, but now you're like, oh shit, the pace of acceleration here is tremendous. And so, Jeff, I really think it adds a lot of salience to your thesis, because now you have so much need for that intervention, for that capital destruction, that repression, up against a wall of, you know, that technological deflation, but another order of magnitude more. So the situation that you described in your book has, I think, took another step in its development, where the two forces are now like another order of magnitude against each other. Yeah. And so what kind of a scenario does that, you know, create?
So there is no way to resolve
socially, economically, all that
stuff. So I don't think we're in I think we're in what will feel like to us, because we're living it, a moment that is going to drag on for a lot longer, and it's going to be more chaotic and everything else. But times in history of great change have gone through these same moments when you got to these debt cycles that couldn't be repaid. When I look through the lens of what I think has actually happened through an entire lens of history, because people will cheat. If you can control money, essentially you can steal the productivity that should be flowing to society and you get paid from everyone who works, and you get a free. So that if you're so what that would say is, if humans could control money for their benefit over other humans, not they might, they will, right, throughout history. And that's what this, and gold shows that, because through this eventually, because gold gets centralized, and then the rules change. So here's what I actually think is how, and I didn't realize this even when I wrote my book. I thought we were living in, just because of the exponential technology. But what I realized is technology has always been deflationary. And the fight against it was the fight against it to control money always led us to this, which led to the short-term debt cycles. And then the short-term debt cycles couldn't be repaid in the market, and people didn't want their banks to fail. So the government stepped in and bailed out the banks and centralized more of the banks. And then the government got bigger, and then it kicked up to a long-term debt cycle where you couldn't pay it back. And you had to create wars and convince your country to go to war to be able to create inflation or something else to be able to reset the rules of the game board. So I think throughout history, it's always been the free market is deflationary. Mm-hmm. The natural state of a free market is deflation, and it's human beings' abuse of that to try to create more power that's created these long-term debts, these debt cycles. Oh, Luke's joining. Luke is joining.
Oh
awesome.
Boy, look who's here.
And I brought Luke to Vancouver to see a robotics company. But let me finish this piece, and so today that trend is just why I use that exponential trend, or that paper folding trend, is you can't see that if you look at AI, how fast it's growing, and you realize that same AI is going to move into robotics, and it's going to move into all of the hard things too, very quickly. What jobs are safe? And so every time that you're essentially stealing the productivity gains of the prices that should be flowing to people through lower prices to concentrate them up in an inflationary market, you're doing it at faster and faster rate. What you're doing is you're driving society to the brink, because what people are so scared of, if prices fell at a rate that they didn't have to work as hard, they wouldn't be so worried. But if prices are rising and they lose their job, they wonder how they're going to buy their food and their house, and the house is going up and everything else. And all of this keeps happening at a faster and faster rate, which is the driving of the brink of the us versus them and society, which creates the same people pulling the strings to be able to say, this is the reason, and all those reasons, it can't be fixed from the system creating the problem. So what Bitcoin is, the hope of Bitcoin is, it's a new parallel system that allows anybody to come over into the new system where prices do fall to the marginal cost of production for the people that are in that system. And then more and more people are joining it.
I guess what I would ask you off the back of that, Jeff, is, and I agree with everything you said, but because of the seeming rate of acceleration and development and deflation that AI is, inducing right now and likely going to continue producing, that means that dynamic that you describe, so basically
it'll accelerate.
Right, exactly. And so, but the kind of the tragedy of it, or the sneakiness of it, is simultaneous to that, people will feel like, they are more productive individually, and technology is cooler and it can do more, and that has some sort of pacifying effect, or distracting effect at least, whereby it's not noticed that the bulk of those productivity gains, because of the medium that's used to coordinate everything, i.e. the money and those who control it, is siphoning away most of it to that growing, metastasizing, controlling entity. Right. And so
this is my thing with potentially Elon Musk, right? And others in that. Now, I can't say this for sure, because I don't know him. I know people who know him really well, but Obviously, it's somebody who thinks in first principles and actually buys Bitcoin on the balance sheet of something would have probably done the work on Bitcoin, what makes it different, right? And somebody who built, remember, he built PayPal. To be able to build PayPal, you'd have to know how the financial system works to its core, especially if you're thinking it in first principles. So you would also realize that if I'm on top of it all, I essentially get to steal the productivity from everybody else at a greater rate. So if you know that, and you're a tech company that's driving to AI, and you know that what that looks like, then you're actually making, by not going to Bitcoin, what you're saying is, I'm going to pretend to solve a whole bunch of other problems by stealing the wealth of society to do so, while pretending to save the planet. Mm-hmm. And it's just not true. And so so the point here is, I actually don't care, because there's nothing that anyone in those systems can do about Bitcoin. Will it get harder? Will people try to? Will people confuse other people? But they're not going to confuse you. They're not confusing me. They're not confusing Preston. They're not confusing Luke. And more of us are starting to just talk about the truth. And as more and more people see that, more people step out of the existing system that they're in into the new one, and the new one gets stronger with each of us as nodes.
Totally agree. I guess the final question there is, do you think AI in this current system, I think we'd all agree that it has a lot of potential in let's say a Bitcoin denominated system, but in the current system, is it a net negative or a net positive because of that
net
dynamic?
negative?
Right.
AI, and think about when it moves into robotics, it's very simple. From the existing system, it will control you. It'll be used to control you. In the Bitcoin, it'll be used to free you. It's that simple.
Mm-hmm. And do you think, my final question on that before we welcome in Luke if he's there, but will this accelerate?
Yes,
it's going to accelerate the growth of the system, but will it accelerate therefore the demise of it as well? Or
both. It'll accelerate both systems. It'll accelerate the consolidation of power from the existing system, and it'll consolidate and it'll accelerate the learning of the new system from people stuck in the existing system. Both will happen. It's going to be crazy chaotic. And what system that you're measuring the world from, if you're measuring, so what would a dishonest ledger say about an honest one? Right? You just think about what we hear in
the enemy.
Exactly. But think about what you hear in the media and everything else. And I just wonder, why do people give it more strength? Why do people give, like, I could care less. I know what this looks like. I know all of the next steps in what this looks like. And I'm on the system that can't be fucked with. And so I'm going to build with all of the builders faster acceleration to the system that can't be fucked with.
Mm-hmm.
Luke Gromen.
Hey guys, how are you?
What's up, Luke?
How you doing?
Not too much. How are you doing?
Good.
Well,
you're walking into
down.
a conversation about AI, deflation, Bitcoin good, fiat bad, just to catch you up to speed.
Perfect.
Those are his favorite conversations.
Well, Preston,
exactly.
Preston, I don't know if you had anything to add to that before we get Luke's take on the current goings on that we've been touching on so far.
The only thing I would add is I think you're at a point now with all of this where they want the productivity gains. They want to continue to see these deflationary forces and mask it all. And they don't want the creative destruction that comes along with all of that, right? If you want to keep pulling productivity to the left through borrowing, you have to allow creative destruction to occur with all that in a free and open market for it to actually exist. But what they keep, Silicon Valley Bank's a great example. You could just go back to like the last 20 years, especially, where like anytime you started to get like real liquidation and repricing of assets, like the skyscraper we're just talking about that was over 100 million and now it's at 1.5. That is creative destruction. It's happening there. But I would say on a net basis, on a very grand basis, if it's an asset that's actually desirable and the right people own it, it's not going to be allowed to experience creative destruction and to liquidate at those types of prices, right? And so you can't have the one without the other if you're actually operating in free and open markets. We're not operating in free and open markets, and the trend of the manipulation is accelerating. So that's
the result of that manipulation is just going to be purchasing power down and repression up. So that's
control.
Right.
Remember, it cannot happen without more control.
That's what I mean by repression. Yeah.
Yeah.
What you're doing is you're delaying creative destruction. It's building up like in a tank, right? And it's about to rupture. When and where, I can't tell you, but I can tell you that tank of creative destruction is building. It's going to rupture. And when it does rupture, there's going to be certain people that just get prices that just don't even seem possible for the monetary units that the world kind of seems to value and think that are the way to value things with. I have a feeling I know who these people are and what types of prices they're going to get for things. But that day hasn't come yet. And, those people are probably just sitting there very patient and just waiting and not anxious. And they're passing the marshmallow test. And it's a big, giant marshmallow.
Can I just say one thing just before Luke jumps in? For Preston, your call on moving all your free cash flow to Bitcoin at the exact bottom of Bitcoin was a brilliant call.
Dollar cost average your Bitcoin. Do not try to time the markets.
That's the second good historic call, if I remember correctly, from Preston. I think the first was the 2017 high, right?
Luck.
Yeah, sure.
Luke, talk to
us. Can you hear me?
Yeah.
Yep.
Perfect. Yeah, talk to you about. Happy to talk about whatever. Thanks for letting me join. I appreciate it.
Well, I mean, again, just to catch you up to speed, we do these every, I don't know, 4, 5, 6 months, and we just hang out and talk macro. And we started off by saying, as we've often been saying lately, there's a lot going on, and it seems like things are that recession that everyone's been talking about for a while. It seems like the indicators are finally, pointing to that's going to start materializing, and perhaps within the next 6 months, a credit event and the various responses to that. And then we've kind of been going back and forth between granular on what's happening, in markets and with rates and money printing over the next 12 to 18 months, and then 10,000 feet with, how Bitcoin resolves a lot of these problems. So I don't know where you'd like to jump in, but the floor is yours.
I would just say that, I think you guys kind of know my views and such of the world. I think in terms of new things that I think are really worth highlighting, this Treasury refunding documents last week, I thought was a real crossing of the Rubicon of sorts. The 3 documents they released last week, where they came out and they basically said, yes, we have a financing problem, or yes, we have a long-term debt demand problem. And here's why we have a long-term debt demand problem. And here's how we're going to address it. And the way we're going to address it is not sort of the way developed markets have always handled this kind of thing, which is we're going to slash entitlements, we're going to slash spending. The way they're handling it is we're just going to stop issuing at the long end and move down the curve and issue it shorter terms, which is how Latin American banana republics have historically handled it. And so there's 2 Rubicons really of sorts that were crossed. Number one, when you read these Treasury documents, it is like chapter and verse things we've been talking about. It's the deficit. It's, hey, we've been stuffing the banks and the money market funds and the pensions with this stuff, and they're full. In fact, they're selling. Foreigners aren't buying what they used to. Hedge funds have been the biggest marginal buyer. They lay out that 70% of the non-Fed buying since 21 has been treasury, or has been households, which is a significantly likely hedge funds. So they're moving to where, you know, they're going to fish where the fish are, which I understand. And I understand the political realities that they can't cut entitlements and they can't cut the Fed. And these are things we all know. And so I just thought it was a really big moment in a quickening of sorts where, you know, it's like, you know, the first step to admitting, you know, to fixing a problem is admitting you have a problem. And last week they admitted they have a problem. And then they decided to deal with the problem by like throwing down another bottle of whiskey over the next 2 quarters by moving to the short end. So it's like, it's really incredible to watch. But I thought, like, in the context of everything we've been talking about for some time, I thought that was, I thought last week's was a really, it punched above its weight in terms of what we've seen in markets. And you saw markets react to it a bit. You saw the S&P go up and you saw the dollar go down a bit. You saw yields come down and all these sort of initial trading shifts. But I don't think it's at all been fully digested in terms of what really just happened.
And John, it's important to note that, like, as they move from not being able to issue long duration because nobody would want to buy it, which is the reason, as they move further and further to the short duration issuance, enrolling everything with short duration issuance, that's when, like, a lot of historically, you can look back through many historical examples, is like, once that happens, now you're just adding to the money supply because it's all just short duration money, right? You can't afford to go out on the long end of the curve.
And are you more susceptible to rate changes as a result? Like, are you more?
No, short duration money
more?
is short duration, and that's why they have to move there, is because it's not susceptible to rate changes. So yeah, I mean,
well, they're expensive. Well, their expense prices faster. I mean, the bonds fall less fast. If you hold the bonds, you're shorter duration, you're less susceptible to rate changes. But also for them, the borrower, it's like financing on a credit card. It's, you know, if they come out and say your rate goes up, it reprices the debt. It increases the rate at which the debt reprices over time.
And we're talking, and right now we're talking about the U.S. and what they're, but when you think about the global economy tied into this system, and Japan and what's happening in Japan right now with their dollar going, what that inflicts in Japan is pain and inflation and everything else, and some of what it could break and cause different things. Like, we really literally, that's actually, I would think, like when we talk about these things, a lot of times, or when you, not this group, but when I hear pundits talk about it, they have a very narrow view of the thing that's going to happen. And sometimes they're right, because, but they're measuring something. This is, economies work like chaos theory rather than a linear event in something. So you can't see the butterfly flapping its wings somewhere else that creates a cascading event around. And there's just so many of those events that could take place anywhere here.
Mm-hmm.
John, I got a question for Luke. So earlier, before you came on, Luke, I made the comment that whatever the liquidation event is that kind of cascades through the market, I kind of think it might be in concert with the reverse repo getting drained somewhere, you know, call it 6 months to a year from now, we see this liquidity event, that we may see bonds get bid through that for a very brief period of time, just because Wall Street is playing it speculatively and with momentum, from a momentum standpoint, and none of them are planning on holding them through the maturity date. But as soon as those rates get low enough, I think the Fed, I think everybody that's any type of central banker at this point realizes they cannot allow these yields to come flying back up to double digits, which is where I think they would naturally go if they allowed them to, in the corresponding liquidity that they have to add into the system. That yield curve control across the duration of the yield curve is going to have to be a thing that they implement within 6 months to a year after their liquidity response. I'm curious, do you agree with that? How do you see it differently? Do you think that the yield curve gets bid during that event, or is this very different?
No, I think you probably would see, and I think it depends on how big an event it is. I mean, if it is, I don't know, a crash, I mean, versus just kind of a plain, I think of a plain vanilla recession, I think it probably lasts more like a, I don't know, 3 to 6 month bid for the long end. So as you sort of get that muscle memory of global capital, so, okay, we're into a recession, and so much of the trading is programmatic or you know, technical anyway, where it's a machine just saying, okay, this print just happened, buy 10 years. And so I think you get some, and the reason I say the speed of the crisis matters, in my opinion, because that speed of the crisis, at least is how I'm thinking about it, will tell us how quickly we get our first, holy shit, I can't believe they're issuing that much paper, or holy shit, I can't believe the deficit is that big this month moment. Because that will be that's where the humans will come into this and go, why am I bidding 10-year paper when, you know, as I phrased it in some of the reports we've done, is the deficit right now is 8% of GDP. Last 3 recessions, they've gone up 6, 8, 12 points of GDP. If we take away the 12, because it's COVID, let's assume it's not, we're going to shut down the economy. Let's just say it's 6, sort of 01. You know, that took 12 months to go peak to trough, you know, that 6% of GDP increase in the deficit. And that's why I say that but let's say 6 happens relatively quick. Like, end of the day, twin deficit nation that's mostly, that is foreign finance historically, at least, you don't flock into the long end for safety when the deficit's 14%. Like, they're going to inflate the shit out of everything. They're going to have to. And so it's a question of, so yes, I think you'd probably get a bid. I mean, we can see already sort of the sensitivity to just, hey, we thought they were going to do 160 billion at the long end. They're doing 10 at the long end, and that got us whatever it's gotten us, 45 basis points, 40 basis points on the 10-year. Great. Now, what's the trade-off, right? The trade-off is going to be, you know, oh wow, GDP growth is better than we thought. You know, and already we've seen that. You know,
I can't see a world where this is a slow, like, subtle recession. Like, they've compressed this spring. I think that even through COVID, they continued to compress the spring of what would be a naturally occurring liquidity event since 2008, 2009. I think they've suppressed it since 2008, 2009. They've jammed that spring as tight as they could make it, and the thing's ready to pop. Like,
it's actually probably even going back before 2008. It's probably 2000, right? And then then 2008 was bigger. This is way bigger again, and that's exactly it. I'd love to, Luke, because how this resolves short term. I actually like how you think about kind of what the Fed could do, because you'd have to think in this, we've got to do something, right? And there's a whole bunch of things that could happen really quickly. You could shut banks, revalue gold, right, to be able to clean something. Now that has repercussions because it makes Russia, China stronger, right, on that same thing. So maybe that doesn't happen based on that, but there are some pieces. It doesn't resolve the problem long term, like technology moving faster and faster. So Bitcoin, I still think, reprices everything over longer term. But I'd love you to just walk through a little bit kind of what you think on gold, on why that could, in a short term or shorter term, play into some of the things that Preston's talking about as these things hit a wall.
So something that surprised me, and this ties into that, into both of your questions, is I had a meeting recently with a client who's been doing this a long time, graybeard, worked in major money centers in Asia, in the US. And he had introduced me to somebody who is a very well-known Wall Street axe, you know, big analyst in a major consumer sector. And we sat down and started talking, and out of the analyst's mouth, and they are a bottom-up fundamental, they don't do macro, other than the extent that, you know, they have to understand where interest rates are and what have you, because they're an interest rate sensitive consumer area. and how quickly they went to nobody's buying our paper. That surprised me. And I think that as we talk about how long will the bid persist, and then what will sort of can be done with gold on the other side, it's possible that I'm underestimating how common knowledge the funding problem already is. Because if that, these people are very well connected. If they're already nobody's buying our paper, and like within the first 3 minutes of meeting me, she didn't even really know me that well. That's kind of a very aggressive, direct thing to say. And that'll only become more common knowledge. It's not going to get less common knowledge. Then that changes the dynamic of this will take 6 months of a bid, and it'll be 3 months of a bid at the long end, or it'll be a month at the long end at the bid. It's just a trade. But where gold can factor into this, the longer they delay implementing the significant negative real interest rates, right? The bigger the negative real interest rate has to be to get out of it. Both because technology's pushing down and
let's just say this. Let's say the same. So because we're saying the same thing different ways. Bigger the financial repression.
Bigger financial repression. Right. Exactly. So, and at some point, and the problem, of course, is that, it's almost like, needing to hold down, a chihuahua, when your debt is low, to hold the debt market down and basically try to strangle the bond market, right? You're basically trying to strangle the bond market. When it's a chihuahua in 2000, you can do it. When it's a German Shepherd in 2008, you can kind of do it. It's now like a friggin' woolly mammoth, and
it's the Harry Potter dog. It's the Harry Potter dog.
Yeah, with the 3 heads, right? And so there's no, and so what I mean by that, of course, is that like you can do yield curve control when you're Japan. You can't do yield curve control when you're the US, because the Fed's gonna have to buy the entire treasury market like now. And then literally like 10 minutes later, the entire mortgage-backed market's going to be, hey, you got to buy us too. And then the corporates are going to be right on their heels saying, hey, Fed. So
what? They let the yields blow out the 15% plus?
They can't. They got to buy it all like now.
Yeah.
And that's what I mean. It's like, the longer they let this go, the more the only option becomes raise rates, knock down the price of the treasury market, right? From say there's 25 trillion in treasuries outstanding. Say now mark to market, they're 15 trillion after they've knocked the prices down, right? With yields going up. And then you write up the gold. Treasury says, hey, Fed, you got to write up the gold every $4,000 is $1 trillion that gets deposited into TGA. And goes right to Yellen's checkbook. So say $20,000 an ounce is 5 trillion. I can buy back 5 trillion in debt in the open market instantly now. And now there's only 10 trillion outstanding against 25 trillion GDP, 40% debt to GDP. Now I can take rates to where I need to let it go. And it's then you can at that point operate an independent monetary policy. And to the point about technology, you can allow creative destruction to the private sector without that creative destruction threatening the solvency of the sovereign.
I don't think you can, because I think what ends up happening is you kick it. I think technology is moving so fast, and technology should be deflationary. I think you kick it to the private sector, it rolls up to the government or corporate, then it moves up to the government again really fast. That's actually why I say gold could be a stopgap trade, and it might be a really good one to be able to do that, but it doesn't stop this train from coming. There is no
no, it doesn't.
There is no resolution to the world we live in from an inflationary monetary policy.
Can I also just ask?
No question.
What do you mean mark up the gold to 4,000 an ounce or whatever it needs to be an ounce? What does that mean?
So there is a book, you can find it online. It's public. It's the Financial Accounting Manual for Federal Reserve Operating Banks. And in it, I think it's section 2.10, but it's definitely in section 2. something. There is the accounting. This is basically like the accounting rules for the Federal Reserve banks. And it says just mechanically, Treasury can say Fed write up the official gold of the United States. And the action of doing that creates an accounting. So gold up, debit gold, credit Treasury General account, which is just Janet Yellen's checking account that she can do whatever she wants to do with. It's just an accounting treatment. It's a little like the platinum coin nonsense, gimmick,
right.
And it's 100% gimmicky, except it's in the Federal Reserve, it's in the financial accounting manual of the Federal Reserve operating standards. So
does it have any influence on the real so-called gold market price?
I would think it would have to, because ultimately it's just one market, and so practically speaking, you would be. What it does is it creates liquidity without creating the debt. Right now, to create dollars, you create debt on the other side. This just creates the dollar with no offsetting debt. This is just straight friggin' money printing.
It really is the platinum coin thing, basically. I mean, you're just taking something and saying it's worth this much now. maybe it's a little bit more restrained than one coin worth $1 trillion, but
if we're gonna properly discuss like these what ifs in the future, I think a really important thing that you also have to do is what else is happening in the backdrop of these events. Okay, so what's Bitcoin doing at this point in time, 1-2 years from now, when all of this chaos is occurring? Is Bitcoin at 100,000? Is it at 300,000? Is it at the price it is right now? Because when you look at those events that we're talking about, what we're really talking about at its core is the erosion of trust of the legacy system. It's people looking at this and saying, none of this makes any sense. They're talking about like platinum coins that are worth trillions of dollars just because they put it on it doesn't even, we're in fantasy land. Meanwhile, you have this thing over here, this alternate system. Let's just say it's at 100,000 or 200,000 of Bitcoin. And people are looking at, well, what backs that up? Oh, well, there's all these people all around the world that are plugging in servers that are consuming electricity. Well, who's their customer? Why are they doing this? Are they making money? Yeah, they make money doing it. Well, how do they make money? Who's the person that's paying for that? Well, it's these people that, have these new coins that can't be debased, and they have trust in this system that nobody can manipulate the number of units in it, and they're paying for the security of it. That's the customer, right? I think that you are, and it gets to kind of a question you asked earlier, John, and you did it in a different way. And what I think you were asking is, are we at the event horizon, or are we very close to this event horizon? And I would argue, and I've been arguing this for a while, on the last cycle, what I told people is, I think we're closer to the event horizon than most people would suggest. At that point in time, at the last halving, everybody's like, this is a 30-year thing. This is going to take 30 years for it to play out. And I was like, I think this is way closer to where we're at in the timeline than people realize. Is it this cycle, next cycle? I don't know, but it's closer than you think. I think on the coming cycle, I think this thing is going to melt people's brains. The reason I think it's going to melt people's brains is because it's died 3 times. It's resurrected itself 3 times. Okay. The 4th time it I'm messed up in my head with the words, right? Resurrects itself.
Come on, you're in the South. You should know the word resurrect. Come on, let's go.
The 4th time it resurrects itself is the time when people are saying, what in the world is this thing that's now at $150,000 for an imaginary Mario coin? What is this? I've seen the tulips chart for a decade straight, right? They're manufacturing these coins at the Fed so that they can add trillions of more dollar units into their TGA. All of this stuff really kind of comes together, and it's a total erosion of trust. And people are going to seek something that solves that trust issue for them.
Yeah, I agree. And I think the same question, another angle to that, was what I asked Jeff earlier about AI. Does AI accelerate the event horizon because it accelerates that disparity dynamic between deflation and money printing? And if we were all pretty much in agreement that AI is accelerating a lot of things, yes, it's probably overhyped and there's going to be a consolidation period. But again,
it's underhyped.
Well,
It's underhyped.
Agreed.
yeah.
Agreed.
So
I guess
I'm
it
telling
matters
you-
who you're talking to. If you're talking to Spencer Schiff, maybe it's a little overhyped. If you're, maybe normal people, maybe it's underhyped.
So, but again, I'm very close to this entire thing, and it's overhyped in the way but to its relation in economies. If you take instead of or AGI, which might be overhyped right now, and you say special knowledge, then what you get paid for the most is having an experts above anyone else. Right, that's what drives economies. That's what drives pay. That's what drives, and the best at if you're the best at something in sports or something, you get paid a lot more than the second best, third best. Same thing in economies, because you deliver that much value in a society or whatever, you get paid on a bell curve like that. And in AI, this is already a narrow AI in industry after industry and industry after industry, and it's just knocking them all down. It's the best by far, right? And so it doesn't matter if it's AGI and best at everything broadly. As it relates to the economy, that's going to happen too, and that's going to get more and more as we move. But the starting step on how it matters for productivity and what these prices should be falling at an exponential rate is because of what I just said. So that and that's not overhyped. That's actually happening right now at a rate that people can't comprehend. Right. But when it's tied to robots, and that robot can do everything you can do at a way better scale and everything else. I brought Luke to Vancouver to kind of show him a friend of mine's company that what this means. And China just made an announcement last week that in 2 years they're going to like massive produce these types of robots that are AI robots. Like when you think there's some growth while that happens, but all that growth removes those jobs at a staggering rate. This is the most underhyped thing in what we're talking about.
Sure, point taken. But that's exactly what I mean, is that all that productivity within a fiat monetary system, much of it is being shifted to the person who controls the money.
It's stolen from us.
Right. But that's the point. That accelerates the event horizon, right?
Yeah.
That's to the conversation we were having before. So but my question, another question is, we talk about these events, right? A credit event, a stock market crash, a war, whatever. But, God willing, the show rolls on, right? We don't destroy ourselves. People will be discussing this 100 years from now. So I guess in your view, Preston, because you used the term, what is the event horizon for you? Is it just the broader recognition that there's only one exit hatch here?
It would be the buying power that the cumulative amount of Bitcoin units like what you could buy with all of those units equal the units from the legacy, the entire fiat legacy system. When those are at parity, I would say that you're truly at the real event horizon.
Does that mean something like the market cap of Bitcoin equals the market cap of whatever other financial assets?
A physicist would disagree with that, because the physicist, like you are guaranteed to go through the black hole at an event that's not like
right. Okay, we're
right.
going
So
there.
like,
all right.
So like you could argue that like right around now would probably be something that I don't think that they can get out of this through austerity and reasonable, actions collectively across the globe. So yeah, you're there, right? That it'd be how you would define it. But for me, when I'm talking to other people and if they don't understand this and they react late. Okay, imagine that we are at that parity moment where all the Bitcoin units are equal to all the legacy fiat units. If you took your net worth and you transitioned it into Bitcoin at that moment, and then we went to the other side where Bitcoin is now the dominant unit of account, like your net worth of what you had retained in savings is pretty much exactly the same. There's no change for you in that event. Okay, leading up to it, there was gross loss, right? And then on the other side, there's abundance. But for all intensive purposes, if you lived in a normal house, had a car, like all of that lifestyle isn't going to change all that much for you on the other side. The earlier that you adopt some type of position size to the left of that 50-50 parity, you are going to have more abundance in what your net worth is, than if you adopted it right at the 50. If you're to the right of that event, you're going to have a smaller net worth than what you had. So when I look at where we're at in that parity moment, we are so far to the left of that parity moment that even if a person has a 1% position size today in Bitcoin, I think it would protect their entire net worth.
I agree.
On the other side. Now, what's going to be really difficult for people is if Bitcoin's at, let's say Bitcoin's at 500,000 per coin in USD terms. I think at that point, that person needs to have about a 10% position size of Bitcoin in their overall portfolio just to be able to protect their net worth. Okay. Now, why that's hard is because people who are going to have watched Bitcoin go from, let's just say the price ran from 50 to 500,000, and it was this big abrupt move. Everybody who's looking at that is saying, well, I'm not going to buy it now. We've seen this play out 3 times prior, right? Like, I can't buy that right now. And the people who are all the crazy speculators buying NFTs and stuff like that, right? The people who have this innate sense of protection and know that when something goes up 10x, that it's more dangerous at that point, is going to be very hard for people to now have 10% exposure to this thing that is transitioning into this other, financial system. And what I think gets even harder about this is as we get closer and closer to this 50-50 parity moment, it might not come back down like it has historically. Like when these currency systems unravel and they transition to a new unit of account for the planet, like you get to a point, go look at the Germany chart, go look at any type of hyperinflating currency. It gets to a point where you don't get those dips in the volatility anymore, and it goes and it's gone and it's not coming back. And there's going to be eventually a point where that happens. I don't know where that's at. I don't know how many more of these like cycles you go through before it literally just kind of rips the face off of it.
See, this is even when Preston's talking, like that you're talking in measured Bitcoin in value of US dollars. And that's the mistake. And it's so we've already reached the event horizon. I've tried I've tried to disprove this hypothesis in every way possible. And there's 3 reasons that I say if Bitcoin stays decentralized and secure. 1, so people do their own homework, why that's effectively inevitable, because we control through the nodes. I'm not changing my node, right? And so as long as we do that and protect that it stays decentralized and secure. But so people do their homework. 2, to realize that how much this existing system is going to try to manipulate people in this, like with money or anything else, to try to create a centralization function of this, right? So you could expect all of these things because if this is truly decentralized and secure, it's already changed the world, and you can't negotiate it with it, right? It's going to play out over this time. So we've already reached the event horizon on this, and what's happening is everybody who's living in Bitcoin and pricing in Bitcoin is watching it happen, watching their purchasing power increase, not in everything terms, in oil terms, in energy terms, in all terms. It's repricing everything else rather than the other way around. But most people are stuck in the opposite system. So it's already doing it. And so when people say, when is it going to happen? It's happening.
It's already happening.
It's happening every day. Right? It's
for us in the world I live, the prices just keep going down, John. They have since 2015. Since 2015, the prices just keep going lower, like drastically lower. I can't understand why people can't see it.
Yeah, we already live in abundance, and the more and more people, we've started a venture fund, right? That it measured in Bitcoin, right? Where the companies are actually collecting more Bitcoin on their balance sheets and growing like crazy. We're going to have performance not against fiat. We're going to be in the top quartile of funds against Bitcoin. right? And as people start to see how much innovation and what's happening there, it's going to attract more people, more capital, and everything else, because they're going to want to try to share and to try to beat those types of returns, which are outrageous.
Well, and I would say too, like layering on the legacy system in terms of the event horizon, these systems always go the same way, which is harder currency, fiat currency, get away, trying to discredit the hard currency. And then you hit a point where suddenly the fiat currency system needs the hard currency again to retain its credibility.
Yeah.
And I would argue, for me, this moment of, I don't think we're quite there yet, but I don't think we're 2 years away from it. I think we're 6 to 18 months away of, if the Fed doesn't hike, they're going to lose the long end because people are going to see that inflation is going to come back.
Yeah.
And if they do hike, they're going to strengthen the dollar. It's going to force this Japanese foreign selling of treasuries, and they're going to lose the long end. And if they're now in this spot where anything they do, I would argue that is the event horizon where they have lost, the legacy policymakers have lost control of the bond market in the reserve currency of the world. That's where you get into people say, well, that's deflationary. Sure, for a moment. But these are not people who like to let things dictate policy to them. They aren't going to lay off the Marine Corps and the Navy and 70 million boomers. They are going to print the money. And so I think we're getting to that point, and I think this common knowledge is building now. And I can see it just in my interactions. You know, I was a lunatic 4 years ago, 3 years ago. And
we all were.
People, right? And now it's kind of...
What do you mean? In what way? In what way?
Oh, I mean, I had people saying that and people would say that I was not credible because I was saying the U.S. had an imminent and accelerating fiscal problem. That basically the U.S. had a debt crisis, and you could see it, and there were symptoms already, and they were accelerating, and here was why. That was not an acceptable view. Now, they still won't say we have a debt crisis, at least in the mainstream. But now they're talking about, I mean, Mohammed El-Arian was on CNBC this morning talking about the volatility of the treasury market and how it's not conducive to because it's trading like Dogecoin. It's trading like a biotech with one drug in the pipeline 6 years from now. And this is the benchmark asset of the whole friggin' system. So there you can see the sentiment shifting along as we move towards what I think is sort of what I would offer is the event horizon for the legacy system that will be a leading indicator for the event horizon as Preston and Jeff have defined it, because that will be the moment where the policymakers say, oh, we can't control the long end anymore. Our choice, no matter what we do, our choice is print and control it by force, or our choice is to shrink our own power, shrink our own spending. And by the way,
and Luke, I think it's important to pile on to that shrinkar. That wouldn't solve it.
No.
Right? There's
not
no
at this point.
Not at this point. We're too far past that.
Agreed.
Solving it. Yeah.
Agreed. No, it'll only solve it in nominal terms. It will only prevent them from going nominal. I mean, I don't know if you guys saw this. I may write about it this week, but there's an MMT guy who did a Freedom of Information Act, and they replied, they being the Fed, the New York Fed, sent him the policies that they put in place back in 2011 with the debt ceiling, just in case the U.S. defaulted on treasuries. And incredibly, the answer is the New York Fed would accept and buy defaulted treasuries at the same par price as non-defaulted treasuries. Like, I look at my wife, I go, are you fucking kidding me? Think about that's through the looking glass. If a defaulted treasury is worth the same as a collateral, as an asset, as a non-defaulted treasury amongst the creator of the currency, There's no debt ceiling. There's no. It's all. It's all.
Nope.
It's all a charade.
We live in make believe world. Right.
Yeah, exactly. Except for the hard asset energy, like you said at dinner, Jeff, back in April. The base layer is energy. Base layer's always been energy.
Yeah.
And it's a little seed growing up in this shitstorm of fiat falling apart. And it's almost like it's coalescing order around itself, you know, little by little, as everything's being destroyed, it's taking pieces of it, right, and putting it back into proper order. But it's such a small thing right now. But because of its attributes, because of what we know it to be, or at least think it to be, we all think it has the potential to convert all of that chaos ultimately into a better form of order. You know, that's obviously the hope. Let me ask you this, guys, and then we'll wind it down. But, you know, a lot is being made of the ETF thing with Bitcoin. We've been talking about repression as basically a, you know, guaranteed for how they attempt to contain or control what's coming. Where do you think the ETF falls in that, you know, in that domain, in terms of looking at things through the lens of repression? Completely separate, integrated in some way, part of that plan in some way? What are your thoughts?
The biggest challenge that they have with the ETF is just look at where all the coins are at right now. These coins are in the hands of the Bitcoin psychopaths, like the majority of them.
And look at keep going, but look at the chart of how many people are holding through drawdowns, how many are off exchanges. Like, try to get those coins back. Go ahead, Preston, sir.
So when you're looking at it, so like, let's just say BlackRock releases their product. We have hundreds of thousands of Bitcoin that flow into that product. The price is going up a ton, and all these people are making tons of money. In the grand scheme of things, like the people that have those shares and that have like all that new buying power through that product, like it's a pittance. It's a pittance compared to the buying power that exists on all the other people that actually have self-custody of their coins and what in the world they plan on doing with their coins. And I can tell you just personally, my coins aren't going into any type of equity unless I'm getting PEs of like a 5 or like a 10. And there's a massive competitive moat on that equity. Like, I'm not parting with my coins for anything better than that pricing. And I would suspect that the people who have a lot of coins, thousands of coins, the Michael Saylors of the world, do you think Michael's going to like give up the coins in his treasury for equity that's priced at 25 times earnings? Get the hell out of here. He's laughing in your face. He thinks you're an idiot. And he's going to continue to think that you're an idiot until you offer him, you know, a PE of 5 or 7 or something like that. And the company's retaining Bitcoin and they're pricing things in Bitcoin. And like that person, the people that control real amounts of Bitcoin, they know the value of it, and they know how to price. They know how to perform economic calculation on things that make money in this world. They don't throw that Bitcoin at things that are a hope and a dream and doesn't make any money. And the founder had a great story. Like, they're not doing it, right? And those are the people that are going to control the strings of the world in this new world that we're going into. So like, when I look at the BlackRock product, congratulations. Yeah, you might get a couple hundred, you might get 1 million Bitcoin in that product, but there's 21 million Bitcoin. And the people who control a lion's share of those coins, they know what the hell they got.
Yeah, so I have a different take on it, similar. But if you think, where does the money that BlackRock invests come from? Right. And the money comes from people like you and I and our pension funds.
Yep.
Right. It's us. And so what we're saying in the existing world, why it concentrates so fast and why it concentrates in the tech companies is because the existing system is manipulated. And effectively what we're doing and our pension funds are doing on our behalfs are trusting more and more media intermediaries who essentially have inside knowledge of how the system works to be able to try to get better leverage than other people who are further away from that system. And that's where BlackRock would sit. So that's where they sit today. And our funds go into these funds who go through a cascade into funds there that are trying to trying to outperform markets that aren't able to outperform Bitcoin. And so now all of those funds are going to go in with a 1% fee or something like that. And over time, they're going to make less return. It's going to bring a whole bunch more knowledge to this space on why self-custody is important. And it's going to start, and some of it's going to start there. And then people are going to go, why am I paying a return? Why am I paying fees on something I can hold in self-custody and not pay fees on and get a higher return rate? And so all of this competition, the free market competition, is a perfect example. It just extends all of this. And what's happening on top of that, that's just the asset, right? The peer-to-peer internet that's building alongside this. Have you ever seen, ever in history, has there been a safer, faster, and cheaper technology that's open source lose to a more expensive, insecure, and unsafe one? Never, right? So you can see where this is happening, and more people with this bringing on. So it's going to bring on a whole bunch of knowledge and why this is important. And then more people are going to start there and realize, maybe I should make more return myself just by holding it myself.
I want to piggyback on what Jeff's saying. I don't disagree with what Jeff's saying. I think that there's an important nuance. What if half of the coins, or more than half the coins, let's say 70% of the coins, would flow into an ETF product that of the 21 million that exist? You might have a real issue on your hands if that was the scenario, because you have a custodian, BlackRock, who can somehow control this. This is the issue you got with gold, in my opinion.
Yeah,
right?
totally.
So that would be an issue. But I can tell you, based on the people that I know, the ones that are self-custodying and where all these coins currently nest, the last thing they're ever going to do is buy an ETF share of BlackRock custodying their Bitcoin. It's beyond laughable to them. Okay. So I think that that's really important. The other thing that I think is important, to go to Jeff's point, is you're going to see an influx of people buy this product. You might have 1 million. Let's just use a simple number. You might have 1 million Bitcoin that flow into these products. Okay. What people are going to find out in due time is, as more people demand payments, immediately settling Lightning payments, okay, there's going to be yield to be captured for routing. Okay. Do you think these people with the ETFs are going to be collecting those fees? They may, through competition, that some of these ETFs might start offering basically almost like a dividend to people that are sitting on this Bitcoin for routing, as there's actual demand for immediate payments. You don't have that demand today. It's not there, but it's coming. It will come. Once the demand comes for that immediate routing, all of a sudden now there's fees to collect by plugging the Bitcoin into channels and allowing that to participate, or to collect those fees. Now, what I think is going to happen is you have all these people flood into the ETFs. Then they're going to realize, hold on a second, there's a really big advantage to me holding my own keys, because I can make 2% or 3%. It's going to become your risk-free rate by holding my own keys and exercising that through some turnkey solution that's going to materialize here. And I've taken pitches. I've seen different things. Trust me, there's something coming. So I think that you might have a swing where everybody wants the turnkey solution in their trading view, or not trading, but into their stock brokerage account, to just buy the ETF because it's simple. They can put it on their balance sheet. And then I think in due time, call it 3 to 4 years later, that pendulum might start to swing back the other way, where people who want exposure to Bitcoin and also want to get a kicker of additional interest are going to want to take self-custody. And you're going to see the desire for the ETF product to not be as high as it is like right now or in the coming.
I think we just want one careful thing. Preston's totally right there, but we got to be careful of, it's not actually yield. It's actually fees that are generated from the Lightning fees. So it's not a credit instrument. It's, you can hold non-custodial Bitcoin, your own keys, and contribute. So no risk in contributing them to the Lightning network to drive liquidity, and share in the fee generation of all those tiny little transactions, which will look like yield.
Yeah,
it will look like yield and be the new free risk-free rate of the new system.
And here's how we can prove through definition that it's not yield, is because you're not giving up the keys.
Mm-hmm.
You are not giving up the keys. It'd be
You're
like
not trusting some custodial. You're not trusting FTX. You're not trusting anybody. You're not trusting BlackRock. You have
you still have the keys.
I
So
absolutely agree that competition and the other value to be derived from Bitcoin, other than just holding it, cold storage or having a custodian hold it, will over the course of time be too enticing, will draw people out of these instruments. I think in the short term, they're going to be incredibly popular. One simple reason is that you'll be able to borrow against it, right? You got $1 million in Bitcoin, you want to borrow against it to get some cash or whatever, that's something that people are familiar with. So they'll probably avail of it. And in terms of this conversation around repression, I mean, it seems kind of far out now. I'm sure we can all imagine it, but could we be in a case where if it's not in an ETF or if it's not with a registered wallet, whatever that is, then it's effectively illegal, or, whatever, because there'll be people that resist that will be called tax evaders, selfish, all that kind of stuff.
Can I jump into that?
I'm saying that's a possibility.
So anything's a possibility in a short term, including so think about other currency regimes where they lock you in and they have mass financial repression to see what would happen here. You create an underground economy that explodes, and the underground economy is the market, right? And whatever you talk, so if all governments got together and did this, Bitcoin would actually grow faster. Because you create an underground economy that would explode. It would force the free market. It would force way more people into it because they couldn't trust the existing system. If one government did it, then there's a massive incentive for other governments to take advantage of the free market. So North Korea can stop the internet from helping their citizens, right? But they can't stop the internet.
Mm-hmm.
Right. So essentially, your choice of not participating in this network is actually removing the wealth effect that would go to your citizens from stopping it. So every country could potentially try to do that, but it won't stop it. Even look at the hash rate in China. How many times have they tried to stop Bitcoin, and still over 10% of the hash rate is in China? You cannot stop this network.
Yeah, no, I totally agree. I think the line they could potentially use, again, I don't agree that I agree they won't be successful, but they'll say something like, well, what do you need, to hold it yourself for? You got a registered ETF. It's got the seal of approval of the SEC. It's with the biggest asset manager in the world. I mean, what you only want to do criminal stuff with it if you don't want to use that option, don't you, Anand? And I think that's why I keep saying kind of on other podcasts is the system we have today has regulation to protect your money from a system designed to steal it. How could that turn out bad? Right. And so with more and more people realize that, you realize, I need to get out of this system that people are telling me is safe.
If your country passes a law that prevents self-custody of Bitcoin, that's a pretty big red flag for you.
Right.
Very
Luke, what do you think about all this?
Yeah, I mean, I think you can see, try to take 10,000 in cash out of one of your banks in America, out of a bank. It used to be easy. It ain't easy now. FATCA, right? My understanding is a lot of Swiss banks won't even take Americans because it's such a pain in the ass. Which is and with gold, they did this. They made gold illegal from 33 to 73. So there's things they can try to do, but there's a lot of having lived the gold, I never owned gold till 08, but having spent time in gold, I think they're trying to run the same playbook. I think which was, you don't need to confiscate gold. You can just convince people that holding a gold ETF is better, and sell your gold and sell your scrap gold and turn in your bars and here, take this ETF. And that's what appears to have happened from the launch of the GLD through 2011 or 2013. Importantly, like the price of gold went up 5x. There's the gathering, right? There's sort of in the short run and in their intermediate run, in order to convince people to do that, you need to have the interest, which means you need to have the price. Americans aren't going to buy anything where the price isn't going up. So you got to have the price go up if you want to try to run that playbook. Now, centralizing gold is way easier for reasons you guys all know. Buying physical gold as opposed to paper gold is way more difficult, or ETF gold, way more difficult as opposed to Bitcoin, where it is much easier to buy physical Bitcoin than it is to buy ETF Bitcoin. So there's a lot of things that are different that I think, from my simplistic view, make it unlikely that they will be successful in centralizing more than some amount and you know, some modest amount, like Preston said. And because the people that know, you know, they know and they understand. And as far as making it illegal, you know, or I think I think I net out on it like Preston, which is, if your country does that, you have to start thinking. For me, it would be a red line, right? It's the same thing as like if they ban the Second Amendment in America, that's the first time I would think about leaving. That's the only way. If they made weapons illegal in America, I would think about leaving. If they made something like that illegal in America, I would have to think about leaving too.
The same, and I think the same in Canada. And Pierre, right, who I talk to often, versus Trudeau, and you know this, John, right? But so you have somebody who's wanting to move to the free market, and you have somebody who is wanting to control it. And so that paradigm is going to play out in every single country, across every single political system. But the more and more people realize what's happening from the control system, that it's actually not protecting them, it's killing them, the more the free market starts to gain an advantage, and people in there kind of get elected. So this is why this is going to be so. It's going to just be really messy on the way through, country by country, different changes, and you can't predict those changes. But I'm the same. I could get on a plane tomorrow, anywhere, and there's going to be a lot of places that are going to welcome me, and business and everything else into those. So if Canada wants to play a harsh rule book, and this, then it's going to cross a red line at some point, and I'll move.
Mm-hmm. Yep. If Fiat, going back to what we were talking about earlier, if Fiat induces tragedy of the commons amongst nation states, Bitcoin produces prosperity of the commons for those that choose to participate in it.
Yeah.
And you couldn't get a better definition of how it changes things other than looking at that contrast between tragedy to prosperity of the commons.
Yeah. And this is the thesis of a very popular book in Bitcoin land, which is The Sovereign Individual, right? When these things start happening, when things start falling apart, when there's, chaos, certain places will adopt more sensible policies, more policies aligned with truth, policies aligned with freedom, and they will attract the people that value those things and have the capacity to go to those places. And then it will become even more apparent that there's benefits in doing so, right? Those people will be thriving, there will be freedom, there'll be prosperity, there'll be peace, and it'll be even more evident to those people that maybe haven't made the decision yet. And that is my segue into my final point, which will be a plug for, I know Jeff at least is involved. I don't know if Preston or Luke are, but speaking of places to go, this has become a popular thing. And, since COVID, basically, like, where are the places where there's more freedom, where there's less authoritarianism, where there's maybe more sensible policies, maybe Bitcoin is legal tender like El Salvador, where you might think of visiting now and potentially moving if things really get hairy. And Madeira has kind of popped up as one of them, a Portuguese protectorate off the coast of Morocco. And they're having a Bitcoin conference in early March of next year, if I'm not mistaken, Jeff. And I think it's called Bitcoin Atlantis, right?
Yeah, that's right.
Why don't you show it before we shut things down?
Yeah, so a couple of years ago, and I one of the people who translated my book was Andre Loja from Madeira. And then he asked me to, and then the president of Madeira read the book, and then so we just developed through Andre first and the president, and what was happening and what it would look like, and how the euro is going to be faced into a time that eventually they're going to have to essentially sacrifice the periphery for the core at some point. And if they didn't, then you would have an explosion of kind of political divide in different countries that would force that, different leaders and such. And talk about what was happening here on the longer term, and how countries or nations could take advantage of this by building policies friendly towards Bitcoiners and what was going to emerge on top of that layer. So he's very on side. Now, it's still it's still they can't create their own policy away from the euro, so they can do some things and everything else, but he very much knows what we're talking about, and very much knows on what he can do and how to build a path to be able to do this. And as such, he's attracted a whole bunch of Bitcoiners. GG who just moved there, a bunch of others, a whole bunch is going on into that. So we put together something called Free Madeira, which is driving Bitcoin adoption, and a whole bunch of things inside Madeira. And then we're putting on a conference. Actually, Preston is running one of the blocks, but it's going to be a really great conference where we're going to go through kind of beginners, what that looks like, and then what the transition looks like, and then what it means on top of what the future looks like on top of Bitcoin layer. So I'm super excited. We've got some awesome speakers coming, and it's going to be, bring your family. It's going to be a great one. P.S. Luke, do you want to join us?
I'd have to look at my calendar. It does sound interesting. So
it's
just send them
awesome
pictures,
spot.
Jeff. Just send them pictures.
Yeah, it looks stunning.
I've been. It's awesome.
That's the point, right? I mean, people will sniff out these areas, whether it's a small jungle town in Costa Rica, as we have now with Bitcoin Jungle, or whether it's a country like El Salvador, or any places where, people where there's a will, right? Where people want more freedom, where they want more autonomy, where they want to interact with each other on a different basis. And that groundswell where people start doing it, showing that it's possible, showing that it's better or beneficial, then it starts bumping up against perhaps the political architecture there, and maybe it's receptive, maybe it's not. And it slowly finds a level, right? Where all these places, I think, are enabled largely by Bitcoin, largely by the economies that can run on top of Bitcoin, and the lack of infrastructure that you need to do so means that these can pop up everywhere. And then it's just a matter of running the clock forward. And I think there's going to be, over the next decade, I think there's going to be a lot of places similar to Madeira, maybe not quite as beautiful, a lot of them, but that have that kind of, there's people there on the ground that want to see that change happen, and they're going to do their best to prove it to others in that area that it's a beneficial change. And then more and more and more options will be available to people that are looking for, a place that's more conducive or more in line with their values, And so I think it's, I agree there's going to be a hefty amount of chaos in the coming years as these things unwind. But tangential to that, I think there'll be a lot of very, very interesting, novel, never before seen sort of places and communities and, places like that bubble up, and they'll be infused with the culture that we often talk about and the values that we often talk about.
I think that's what it's not clear for people who aren't in this space all the time. You're in the space all the time. Preston's in space all the time. Like running a fund in this space or all the time. So seeing hundreds, if not thousands, of companies building into the space, and the intersection of what's coming that people have no idea that's coming. This is way more powerful than the internet. It's literally a peer-to-peer internet tied to money, and the entire tied to energy that can't be screwed around with. And so that base layer is so solid now, and getting more and more solid, more decentralized, and more secure, that you have this explosion of innovation happening on top of that base layer. That I built a whole bunch of companies through the internet. Like, I was early in the internet. I was invested in the internet. I understood what the world looked like at that point and what people said about the internet. Exactly what they're saying about Bitcoin today. Through that phase, and I understood what that looked like, and that it was very powerful at that time. Some of the smartest people I knew were building on the internet because they could see a different future. It pales in comparison to what I see now. It's and I just part of the reason it makes me so excited, I would want more people to see it, because when you're in this, you can't help but just be massively optimistic if you're spending your time around those people and what's coming. I understand the world doesn't see it yet because they're living in this chaotic hellhole that's getting worse. But what replaces it is so powerful.
Exactly. And it'll be on display first in these jurisdictions,
in these regions. Yeah.
Yeah. Well, gents, this has been great. Love talking to you guys. I'm going to pass it around now to closing remarks and shut it down. Luke, why don't you go first?
I would just say thanks for inviting me. I enjoyed the conversation. I've nothing to add. It's been very informative for me. So thank you.
We'll have to get you in on another one in the future. Great having you.
Perfect.
Jeff?
Yeah, just so good to see you guys as always, and look forward to doing some things in real life.
Preston?
Have a podcast, part of Ego Death Capital. I religiously read Luke Gromen's newsletter every week. That's all I got.
Well, thanks again, boys. And it sounds like we might all be in Madeira in March, and it's going to be great to hang out and have some good food, have a few drinks, enjoy the natural environment, and talk more about Bitcoin as we always do. So until then, gents, take care.
Thanks, John.
Thanks, buddy.
You too. Thanks, guys.